Welcome back to OpenLine. We have John Blackwell with us, Blackwell Realty and Auction, and Harlan Holmes, Farmington Financial. We're talking about real estate in Middle Tennessee and also answering your questions about when should you refinance and mortgage questions. Let's go to Jack now. Hello, Jack.
Hello, gentlemen. How you doing?
Good. Great. Go right ahead.
All right, what I'd like to ask is this. First of all, I'll let you know that we've been retired in Nashville for some time now, and we don't have any real debts or anything, but here's the situation. We have two huge homes that were built behind us, and I mean huge. We've watched them go up from the ground to the top, and they're both basically very bad pieces of construction. And I also know that Codes has slapped a freeze on the construction because they're in such bad shape in many respects. What is going to happen essentially? I mean, they've still got these things on sale, and what can happen eventually to any salesperson or realtor or anybody who tries to sell them if they're under a restriction from Codes?
I can probably answer that for you. Those guys they'll work through their issues with Codes and they'll get a final at some point, but you're right, they do. Issues come up and things didn't get done the way they wanted to, or the water drained on the neighbor and didn't do that properly. And I'll tell you, those guys in the Metro Codes office, they're fantastic. I mean, they're working their tails off. You're talking about a tough job they've had the last 2 or 3 years. And the way they treat people and have to deal with people, they just really, I got hats off to those guys, because any experiences that the folks around me have had with them has been really amazing. So, and they do a great job of addressing the neighbors. I think all the local people really listen to what the neighbors have to say. But, Jack, they'll work through those issues. I know you're probably not real happy that, they built these houses and shadowed your house there. And that's one of the things that's just in a changing environment, it's just going to happen. And that's pretty tough, but they will work through it. You will have 2 neighbors back there, and hopefully they'll be sweet families, and things can change.
And I mean, he may not want to hear this either. Does it increase the value of his property? I mean, is there a bright side along there, or does it decrease the value? I don't know. I mean, there is frustration with this all over Nashville.
Sure.
When somebody builds, 2 homes, generally they're going for some outrageous amount of money.
Right.
The bright side, I guess, could be it's going to increase the value of your property.
And it has. We've watched it march into different, neighborhoods with values and changing and drastically changing, and so yes, it completely has changed the value of properties all over town, and it's been a windfall for a lot of people that wanted to sell, but the folks that are left in the community that didn't ask for this, and aren't going to sell, like like Jack's talking about. He's happy where he's at. He'd just soon not have all this going on, but there's a large part of the population that's glad it's happening, and it's been a real windfall for old school Nashville folks that have been in neighborhoods for a long time.
And as I said, okay, going to break, we were going to talk about renters, and again, around the time of the downfall, everyone thought there was this new landscape that, and maybe we're seeing it with younger people, I don't know, that people would rent, not have to worry about the bottom falling out of their house, not have to worry about repairs. People would rent. And are you seeing that? I mean, what are we seeing with this philosophy of rent versus buy?
Ton of renters. I mean, and after the downfall, you just look around Nashville, look at the landscape downtown, the condos they built. Now, obviously, some of those are for sale, but there is a huge market for rent, and obviously, a lot of people that are renting, they can't buy for whatever reason, whether it's credit issues, whatever. There are people that are young, that are not committed to a job, they're not committed to field, they're not even committed to living here. They're here for, who knows, are they going to be transient, but what John was alluding to earlier, we have so many families moving here that most people, and I think in our market is so good, property values are so good. My dad told me when I was 18 years old, I bought my first house when I was 18. Now, it's been a long time ago, but my dad told me, he said, every time you make a mortgage payment, you're putting money in the bank. You can't say that renting a house. You're not getting any tax breaks. And it's incredible. The people, I was telling you at break, I had a guy that I closed a loan that had rented for 10 years at $1,800 a month. Guys, put a pencil to that. you're talking about 200 grand, over 200 grand. He paid rent, and the funny thing was, the guy found a house that was almost twice as big as what he was renting for $300 a month less than what he was paying. So, you know, I understand there is a time and a place for renters, but if you're, like John said, if you're going to be here and you've got a job and you're committed to Middle Tennessee, you're going to rent or you're going to buy. And you can't tell me it's not better to buy a home and invest in your future, because that's what you're doing.
And, you know, and a lot of young professionals that are in the career track, and they're like, I may just be here 3 years and be transferred, that sort of thing. Well, then, you know, in that instance, then if you do decide to invest in this market, you know, they need to do a 15-year. There's no way. You know, start getting some equity right away, and that way, if that transfer does come along, and, you know, and a lot of times I deal with relocations. So a great company is going to probably do a relocation package with you as well. So, you know, that's kind of, I would shorten it down if you think you're in that boat.
What are you seeing in other markets? So Nashville, we've heard, it's no secret, we're booming. What are some markets maybe that aren't booming? And what are we seeing across the country?
Atlanta, there's the Atlanta area. I do multi-states in finance, and the people of Atlanta and the suburbs of Atlanta are still dealing with the fallout from the property values. And, you know, fortunately, you know, the states that got hit really hard were California, Michigan, Nevada, Colorado, Florida, Georgia. We're kind of jaded because we're in a great environment with a lot of growth and a lot of people moving here in a great city and a great surrounding counties. But there are, like I say, the Atlanta market has still not quite recovered as far as the values coming back. There were people that were buying in 06 and 07 that they lost half of their property value. I refinanced a guy that paid $175,000 for a house, had it appraised 2 years later, it appraised at $107,000.
That's brutal.
It's brutal.
I went through, in October of 08, I went from about 200 contacts a day to none. I mean, it was like a faucet, and it was within a one-day period. Right after Lehman Brothers, whew, and I said, okay, what are you going to do now? Right, so we had to find ways to make a living, and so what happened though is people, I'd been a pretty productive agent, so people called and said, John, I still want you to come out and list my house. So I go out and sit down with them and have dinner with them, or sit at their table at night and go, knowing that they weren't going to like what I had to tell them, because it was a 40% drop. From October of 08 till about January, when the reality started, it was 40% off. And nobody wanted, and people didn't realize how severe that was. And so for about a year and a half, I would go 3 or 4 evenings a week. People started knowing I wasn't going to sell their house, and sit down with them and go, here's the numbers. And so what you had to do is, but there were great deals with foreclosures, short sales, and so there's some needs in real estate at all times. And so, but you knew that was all it was going to sell. There was no such thing as going to list in a house and it's selling.
Right. And so that gets back to how important it is to price the house correctly. And in a time like that, the news is devastating. At a time like this, I feel like people now are just shooting for the moon.
Right.
And maybe, I don't know, are they overpricing? Are you seeing overpricing? Is it possible in this market?
I'll tell you, there's some markets that aren't as hot. You know, a tree is going to grow so high. You know what I mean? Even in the best market. So, the higher end is going to be more. There's certain markets in this town, areas, micro markets that are great high end, but there's some high end in this market that's really starting to soften a little bit, and you're starting to see opportunities there. And so, yes, we're starting to see that kind of a normalization happening. There's still demand. Folks are still coming in every day, but there's only so many people going to afford a $500,000 house. So if you're building, all you're building is $400,000 and $500,000 houses, and you're a builder, that may not be your best game plan. Okay, because you're going to get some sort of normalization at some point.
And what a number of, I guess both your customers are people that are wanting to buy a second home, rental property, that kind of thing. Because I think we saw a lot of that, and then that got people in trouble.
I think, and I think John will concur with this, the majority of the people that we deal with, and I'm going to say, for me, 90%, it's primary residence. I do investment properties, I do second homes. I've done some second homes in the mountains. I've done some second homes in Florida at the beach. But for the most of my clients, it's primary residential housing.
And if I'm sitting with somebody that wants to be a first-time investor to go get that first rental house, I say, guys, you got to have skin in the game. You got to save that first $30,000 and go use it. I said, there's no such thing as zero money down, or there's all those things that you hear about. And
that did happen.
Yeah,
that was happening in 2008.
Oh, absolutely, it happened like crazy. But in this modern times, if it's too good to be true, it's too good to be true.
It's 25% down to buy a rental.
Is it 25% down?
25% down.
You can do it with 20 with local banks and things like that. But you really need to be vested enough where you're not going to get, if it doesn't go how you thought it was going to be. Guess what? Not every plan goes like you think it's going to go. So when that happens, you're ready, you've got some buffer there, you're covered. And so that's the smart way to do it. And there are a lot of people that are prospered in this environment, so a lot of people are doing that. But they're usually got a lot of skin in the game on that second house.
And after the downturn, there were some people that hit, a lot of these people that hit home runs on investment properties. They came running when all these foreclosures, people that had money came in and started scooping those up and have done really well for themselves. But I think for the most part, and there's still, investment properties, people are buying. I think there's a lot of the investors that are buying investment properties. They have a bank, they have a lender that's not a traditional Fannie Mae, Freddie Mac that they get money from, that they've had enough experience and have done enough business with them that they know that they can perform on the loan.
Well, let's go to Helen. Hello, Helen.
Yes.
Go right ahead.
My question is for someone who has cut back on work and is earning $25,000 a year, single person. What would that person qualify for, and what would the credit score need to be?
Well, Helen, it's amazing. did a refinance for a lady that has $1,300 a month Social Security, but she had very little debt. What it comes down to, it's hard to answer that just by what you gave me, but your credit score to do a government loan is going to have to be 600 plus, and 25,000. If you make 25,000, you could be in great shape. It has to do with what they're paying. Do they have car loans? Do they have installment loans? Do they have credit cards? I would love to chat with you if you'd like to give me a call, but there are several factors. It's hard to answer that without knowing more information.
Okay. And I guess that's a great question. And what are some of the big questions people have, and maybe mistakes they might make, or misconceptions they might have? What is out there?
The biggest mistakes you see, the people that have had credit issues are people that have gotten too many credit cards and have got stretched thin, because you can look at a credit bureau report that somebody has no collections, no judgments, and has made every payment on time, that still has a low credit score. Because if you have a credit card with a $10,000 limit and you owe $9,800 on it, your credit score is going down. If you have 5 of those, you may not even qualify, because that's a huge red flag to an investor that you've got $50,000 in limits on your credit cards and you owe $48,000 on them. So spending too much on the credit card, what an investor loves to see is a $10,000 limit and somebody owes $1,000 on it, or $500 on it. Maintaining your score, medical collections are a big deal, and I know that affects a lot of people. We try not to take too much stock into medical collections, because I don't care how good your insurance is. I've dealt with people over the years that have had really significant medical things that have happened in their life, and it's hurt them. But it's all about paying stuff on time, not getting over 30 days late. That is the key. I don't care if it's due on the 1st, and as long as you pay it on the 29th, you may have to pay a late charge, but do not let that go over 30 days late. That will cripple your credit quicker than anything, having a bunch of delinquent payments.
Right. Very interesting. Okay, we're going to take a break. If you want to call in, there's the number 615-737-plus, 615-737-7587. Take a break. Be back right after this.